Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. I put this show on to try to help communicate a lot of the different areas most of you have, and some of you know you need help in certain areas, and others are not even aware that you need help in certain areas. I'll tell you what I mean. We see a lot of focus, and I talk about this with the markets, and we see it in the news every day, and it's exciting to watch, and it's kind of disturbing to watch sometimes when the markets go down, but we watch it attentively, and it's at the forefront of our attention when we think retirement planning, college planning, any investments, anything. And when we think financial planning, most people just think of the markets. But what I'm here to share with you today is a theme about so many of the underlying areas that people don't pay any attention to because there's no attention being put on them. They might be seen as either boring or neglected through just not realizing how important they are. So the first thing we get into when we're talking about either retirement planning or estate planning or college planning, sometimes the question never gets asked, the simplest little questions. Like, do you have a will? And we look at the situation in all the areas of, we'll see some of the people be so attentive on market allocation, asset allocation, all these different things. And then we bring up the question, do you have a will? Well, no. And you'd say, what does that have to do with financial planning? Because I'm a certified financial planner and an insurance broker. So what am I doing talking about a will? Isn't that the area of legal expertise? And am I a licensed attorney? I am not an attorney, and I don't provide any legal advice. But what I do as a financial planner is help identify areas where people need help and help steer you with the knowledge to go see the attorneys where you might not have recognized to go see them. So we talk about areas when I bring up a question, do you have a will? I have a financial planning reason for that question, but I can't provide any of the solutions. You actually have to go see an attorney for it. But the financial planning reasons can be as simple as if you don't have a will, it might disrupt our total financial planning. And if you do have a will, the beneficiaries might conflict with the beneficiaries you've chosen on your financial assets. So my first issue today is if you pull and go through all your accounts, you pull your will if you have one, if you don't, go get one. The reason you want to have a will is usually pretty obvious. Most people don't have a will, don't have them if they've been afraid to talk about it or think about it. Some people even have superstition. If they think about it, a will about dying, then they'll die, So we run into that. And the area of issue avoidance, it doesn't work, folks. So what we do is and I've said this in other shows, can't necessarily control what happens to us, but we can control many of the times the effect that we allow it to have on us. So one is the devastating or lack of a devastating effect on our families. If we have a will, we've basically done step one. There are people who say, have a will, have a living trust. That's the area of the attorney's world. My area on financial planning is let's just have all your affairs in order and let's use the professionals to do that. So let's use the certified public accountants for the taxes. Let's use the attorneys for the legal documents. And let's make sure then that we as financial advisors are working with your attorneys. And here's where it becomes important in the financial planning world. Don't you think we want to match your beneficiaries to what you had in your will? When we look at your 401k, your annuities, your life insurance, your IRAs, and your will, is it your intention that they don't all match? What we're finding most of the time is they don't match, but it's not on purpose. What we're finding is the reason the beneficiaries don't match are because they were done over a period of years, and your circumstances changed. So your next new employer had a 401k. You put into your 401k the beneficiary designations, including the new children and the new grandchildren. And then none of the other documents that were established prior to that date have been updated, including the will. So my message today, number one, pull all of your documents, pull all of your resources, your 401k, your life insurance, your IRAs, your annuities, and your will. Get them all together. Go review with your attorney. Why would I have your attorney review your financial documents, your pensions at work? Who's your beneficiary on your pension? Have you even established a beneficiary on your pension? I talked about that last week and 2 weeks ago, how important that is for the survivorship options. If you don't have a beneficiary listed, that pension may go up in smoke. There may not be a survivor option, or it may default to an estate. So what we're trying to do with beneficiary designations, and why you have the choice when you're given by maybe some of the attorneys you see, they'll say, get a revocable living trust. Some of you will be told to get a revocable living trust or advised to because it avoids probate in some cases. And the attorneys will go through that all with you. So let's say you're of the scenario, you've decided through your attorney to get a revocable living trust instead of a will, for example, and update all of your beneficiaries on all of your forms, which the attorney advises you to do on your financial instruments. And then let's say you neglect to list any contingent beneficiaries. It is possible in those cases, by having a primary beneficiary, maybe your spouse, and not listing any contingent beneficiaries, that if something happens to both you and your spouse, now there are no remaining beneficiaries on some of those documents possibly, and bam, you've just by default exposed that asset to going through the estate, which is going through this process of probate, which is exactly what you were trying to avoid on why you did the living trust in the beginning. So, folks, I implore you now, get all your beneficiaries reviewed. And I think if you pull everything together like I'm saying, I'll bet you'll see the beneficiaries don't match. And that's something that you could attest to. Hey, I saw on the show, and I wanted to test that theory out because I think they do all match. And you go pull all your forms, and by that I mean your IRAs, your 401ks or 403bs at work, your pensions at work, your life insurance at work, your life insurance on your own, your Roth IRA, your traditional IRAs, your annuities, and you pull all those together, and I'll bet you find you missed some beneficiaries. Oops. You forgot a contingent beneficiary, forgot the kids. That happens all the time. So that's message number one today. And again, it's the message of get to your attorneys. The other thing I want you to do is while we're in this process of reviewing all your existing documents, I want you to pull out those life insurance policies that you have, whether they're term life or universal life or whole life. But I want you to pull those policies out. And I want you to do what I consider a life insurance policy audit. By that I mean if you have term life insurance, I want you to evaluate the remaining term on that term life and see if it's still long enough. Are you getting closer to the expiration of that term? Is your health still good enough that if you wanted to extend that term or repurchase a new term, maybe a new 30-year term or a new 20-year term, that you're healthy enough to go out and shop and do that? The other thing you will look at is your universal life policies. We would do a life insurance policy audit by requesting from the company an in-force policy illustration. And what I'm asking the company, and what you can ask your company to do, or let us know and we'll be glad to help you, show you how to do it, is you're requesting from the company a new illustration. So you have the old illustration when you first purchased the contract on what expectations of cash value build up, premiums, death benefits, etc. on your universal life policy, for example, would look like 20, 30, and 40 years from now. But because of interest rates and market cycles, we in the financial community are finding many of those, especially variable life and universal life policies, are not performing as originally illustrated. Their initial illustrations showed sometimes higher interest rates than we now have today, which has disrupted the growth or the projected growth or the expected growth of the cash value to help offset the premiums that were required. And in many cases, when you request this in-force policy illustration and get it back from the company, you'll read on your illustration, your policy is going to cancel. It's destined to be running out. And you didn't even know that. Nobody has looked at it since you first purchased it. So what you'll see sometimes is the policy will last forever and things are fine. Most times, you'll see that it's different than your initial illustration. And sometimes you'll see it's in dire risk of canceling within the next 5 or 10 years due to being insufficiently funded. In other words, the premiums you're paying as originally scheduled aren't enough to carry the policy. And in fact, the policy might already be draining from the existing cash values, deteriorating the cash values to help offset and support the premium payments. Bam! There goes your financial planning on your life insurance when you had universal life insurance, for example, and then you'll find it's running out where it was intended to be there permanently. We've run into a lot of those cases. So when I look at this beneficiary review and I say, get all these instruments out, I want you to not only compare the beneficiaries and make sure they all match, which I think you'll be surprised that I'm right in many cases, but I think you'll also want to take that one step further on your life insurance and reprogram your needs from this point in the future and reprogram and look at your policies, the ones that are existing. Do that life insurance policy audit, contact the company, request an in-force policy illustration, get that illustration, and you'll see the projected value growth, and then you'll see the guaranteed value growth. You need to look at both. You need to find out whether you're comfortable with the projected value growth and the guaranteed value growth, or is your policy in jeopardy of canceling? And if so, is it too late to save it? The earlier you get on that, like anything in the medical field, the earlier you get on it, the better chance you have of curing it. Is the same in the financial world. The earlier you get on that, the better and less painfully you're able to potentially solve that. Sometimes the solution is within the policy itself. Sometimes the solution is you have to rewrite a new policy elsewhere that will be more stable. You never know. Sometimes it's just adding more money onto the policy that you have. Okay, now back to these beneficiaries, this beneficiary review. We get to your 401k and we get to your pension. And when I look at the 401k, there's a provision in 401ks that isn't really anywhere else. It is a little bit in the IRA world, but you'll find it in the 401k especially, and it deals with the beneficiary review. Well, again, with how does beneficiaries, which is an area of the legalities, play into the financials? Here's an example. You have a 401k, your spouse is a beneficiary, you're divorced, or you're still married. Doesn't matter, it's still an issue, because a spouse has to sign off on any rollover that you do on your 401k. Did you know that? And a spouse has to sign off on any beneficiary change requests that you make. We have seen and heard of cases where the spouse never signed and there was a rollover or whatever, and it went to a new spouse, a second spouse, let's say, or the kids from a first marriage. You reverted back to changing the beneficiaries to the kids from your first marriage. And here, upon the person either passing away or not passing away, but usually passing away, the ex-spouse or the current spouse is allowed to invalidate, in some cases, any beneficiary changes and any rollovers that didn't request their prior signing off and approving. And we look back and say, wait a minute, this is a problem because we're not now married. Well, you were when you did the rollover. You were when you did the changes. So again, you get to your attorneys when you're doing financial matters. Do you see how complex this is? We would normally in the financial community just do a rollover. But because I'm a certified financial planner and recognize advanced issues with financial planning beyond the area of just financial, I am the one who is going to guide you to, before we do anything, you need to review with your attorney. And you say, why? Hey, get to your attorney, have the attorney contact us. We'll explain why and some of the complexities. The attorneys don't know the financial world. The financial world doesn't know the legal world. But the two together can work together very well. And we as financial planners can explain to the attorneys, here are the issues of our concern. The attorneys can explain to us, here are their issues of concern. And by working together, you might be able to make sure that your wishes are indeed fulfilled and not, in fact, deprived due to lack of the fine print in these documents not being followed correctly. So we want you to be careful there. I've had other cases we run into where we might have beneficiaries and somebody says, you know what, I heard I should do a revocable living trust. And in a revocable living trust, for the purpose of, it's supposedly going to help us avoid probate. And this dreaded process of probate, which most attorneys share with me, pros and cons on that argument. So I'll just defer that to your attorneys and the discussion between you and the attorneys. But I will tell you, for many people who have chosen to go the living trust route, they've chosen to establish a living trust to replace a will, because all assets that go through a will, they're told by their attorneys, are going through the process, the cumbersome, supposedly cumbersome and expensive process of probate, which includes publicity. And they say through this process of a living trust, they can hopefully avoid some of these problems with probate. So they retitle assets into the living trust, hoping to avoid the process of probate and publicity. And I look at that, and sometimes you will see annuities, IRAs, not so much life insurance, but we'll normally sometimes see annuities, IRAs, not only life insurance, but you'll look at 401k beneficiary designations, things like that. And you'll see some of these assets put into the living trust. So what I want you to ask your attorneys are this. Are these other assets that we have, such as a fixed annuity, that have beneficiary designations already, necessary to put into the living trust? If those assets have beneficiaries, don't they already automatically avoid probate? So you ask your attorneys that, get the answers, and move on from there. But you look at the case of, is it true that any of the assets, as a rule, that you have that have established beneficiaries on it, in fact already might avoid the process of probate? Well, here, let me share something with you. I've had many people say, I updated my will, so now all my beneficiaries are correct. And I'll say, wait a minute, your annuities, your 401ks, your life insurance, your IRAs haven't been updated. And the people will tell me, yeah, I know, but I updated my will. Or it automatically will update everything, right? No. The way it works in the financial instruments of IRAs, 401ks, life insurance, annuities, all of those contracts are contractually committed to paying out directly to the beneficiaries listed inside the contract. They do not get controlled by the will. The will controls probatable assets as a rule. The annuities, the life insurance are contractually controlled. So your 401ks, your IRAs, your annuities, your life insurance. That's why I said you need to get to the attorneys. Because those assets that I just explained, those financial instruments, might say your ex-spouse still, or a deceased child still, or a deceased brother and sister that no longer live, and here they're still beneficiaries, but you updated your will, and you think the wills will control IRAs, 401ks, but they won't. So with that knowledge that I share with you, get your financial planners working with your attorneys and work together to make sure that you have a solid estate plan for yourselves and family plan, family financial plan. All right, how about this one? We have a situation, and let's say I have an elderly couple that a spouse is in the nursing home, and their assets have been positioned to the point where the spouse at home has assets that are protected from being lost to a nursing home, and the spouse in a nursing home has been depleted and is now on Medicaid. So let's say they're Medicaid eligible and the spouse in the nursing home is receiving Medicaid. Now, where did we go wrong? In reverse, we forgot to ask all the family attorneys to pursue one step out and ask, hey, do we need to make sure that institutionalized spouse is no longer the beneficiary on anyone's other financial documents? Most people don't even think to ask this. But in the process of this, we see the brother passed away. He's 87 years old. He only had a sister and a brother. The brother was predeceased. So this sister in the nursing home inherits his $1 million. And poof, over time, that $1 million is her asset in some cases, exposed to the risk of being lost into the nursing home. We would have maybe asked the attorneys, should we remove her as a beneficiary and have someone else or something else, a trust or whatever, substituted as a beneficiary, because once they're institutionalized, we didn't want them receiving any money. We run into the same situation sometimes with special needs children, where they're on Social Security and we can't afford for them to receive money or they'll get kicked off of Social Security. Folks, this is the world, the combined world of financial planning and the legal world. Have us all work together. Your lives will be more secure, and we can each share information the other discipline does not have. All right, folks, I'm out of time today. I'll be back again next week. I hope some of these things help, and get to those financial documents, pull them out, and let me know if I'm right. Thanks again. We'll be back next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.